Welcome. You have just closed the books and prepared the financial statements. Now those numbers have to do real work. They must explain the business to your leaders, satisfy regulators, and survive an external audit. In this section, you will learn how management reporting turns accounting results into decisions, how the Securities and Exchange Commission filing calendar governs public companies, and what the year-end close adds beyond an ordinary month. Think of this as the bridge between a clean trial balance and a credible public story about your company. Why begin with objectives? Because this section is broad and you deserve a clear map. By the end, you will be able to build a three-way variance analysis and a bridge that explains performance changes. You will assemble a board reporting package and brief the audit committee on the matters it requires. You will apply the Securities and Exchange Commission filing deadlines by filer category and know what belongs in each form. You will perform a going concern evaluation under the accounting standard, and you will run the additional procedures that make a year-end close different from any other month. How do you know whether your results are good? A single number tells you almost nothing without a comparison. Variance analysis is your primary management tool, and it is also a close control because an unexplained swing may hide a recording error, a cutoff problem, or a missing accrual. The three-way framework compares actual against budget to show where you departed from plan, against the prior period to reveal trends and catch mistakes, and against the prior year to show the trajectory that external stakeholders care about most. Every variance above your threshold needs a written explanation. Next, let us see who owns those explanations. Who should explain a variance? Not the finance team. The business unit or department head owns the explanation because they ran the operation that produced it. Finance owns the format and the completeness of the package, not the narrative itself. This separation keeps accountability where the knowledge lives. To communicate the result, you build a bridge analysis, a waterfall that walks from the prior period or budget to the current result, showing the contribution of volume, price, mix, and cost. Bridges are the most effective way to make a financial change land with senior management and the board, because they turn a table of numbers into a story. Once the variances are explained, how do you keep leaders focused on what matters? You translate the close into a dashboard of key performance indicators. On the financial side, you track revenue growth, gross and operating margin, EBITDA and its margin, net income and free cash flow. On the operational side, you connect back to the earlier cycles with measures like days sales outstanding, days payable outstanding, inventory turnover, and available liquidity. The dashboard connects the accounting close directly to the business performance discussion, showing each measure against its target and its trends so leaders see not just where you are, but where you are heading. Numbers rarely speak for themselves, so who gives them a voice? The Chief Financial Officer, through the financial commentary. This narrative explains in plain language what happened, why it happened given market and operational context, and what is expected based on current trends. It is the most dread part of the management package, because it is what your board and senior leaders actually use to decide. The commentary must be factually accurate, neither misleadingly optimistic nor overly pessimistic. And if you are a registrant, it must stay consistent with the management's discussion and analysis in your filing. An inconsistency between internal reports and external disclosure is a genuine enforcement risk. Where do these results finally land? In the board reporting package, the most senior review in the close. It bundles summary financial statements, the dashboard variance commentary, a bridge on key metrics, the updated forecast, liquidity and covenant status, key risks, and any subsequent events the board should know. Before it goes out, the Chief Financial Officer performs a comprehensive review, the senior team's last line of defense before results are communicated. The Audit Committee needs more, focused on accounting. Significant estimates and judgments, policy changes, corrected and uncorrected misstatements, the audit status, any management override of controls, internal audit findings, and related party transactions. Why treat the calendar as sacred? Because the Securities and Exchange Commission deadlines are fixed by rule and are not negotiable, and missing one triggers enforcement and a delinquency status. Your deadline depends on your filer category, set by public float. A large accelerated filer with float above $700 million files its Form 10-K within 60 days of year-end and its Form 10-Q within 40 days of quarter-end. An accelerated filer between $75 and $700 million gets 75 days for the annual and 40 for the quarterly. A non-accelerated filer below $75 million gets 90 days and 45 days. Know your category before the year begins. What actually goes into these filings? The Form 10-Q is your quarterly report with condensed unaudited statements, selected note updates, the quarterly discussion, market risk disclosure, and the officer certifications. The Form 10-K is the full annual report, audited with complete notes, the management report on internal control, the auditor's integrated report, business description, risk factors, and director information. When you announce earnings by press release, you must file a Form 8-K within 4 business days. That release does not replace the 10-Q or 10-K. All financial statement data must be tagged using the XBRL taxonomy, with a dedicated review before filing. If you truly cannot make a deadline, Form 12b-25 buys 15 days on an annual or 5 on a quarterly, but it signals trouble, so use it sparingly. Analysts read one section above all others. The management's discussion and analysis, the narrative of your filing, is where leadership explains results and outlook under Regulation SK Item 303. It must cover results of operations, and crucially it must give the reasons changes occurred, not merely state that they did. It must cover liquidity and capital resources, including known trends and any going concern factors. And it must disclose critical accounting estimates, those that are both material and require a high degree of judgment, like goodwill impairment or the credit loss allowance. For each, you describe how it is developed, the key assumptions, and a sensitivity analysis showing what changes if an assumption moves. Legal reviews the draft, and it must stay consistent with your internal reports. How do you make an audit run smoothly? It starts with knowing which audit you face. Public accelerated filers get an integrated audit covering both the financial statements and internal control. Non-accelerated and private companies get a financial statement audit. Quarterly filings get a review, which provides only negative assurance. The most operationally intense part is the provided by client list, the schedule of documents the auditor needs. Name one audit coordinator, respond to each request within the agreed time, never hand over draft schedules, and prepare obvious items proactively. At the end, management signs a representation letter, confirming all information was provided and no material errors exist, and the auditor cannot finish without it. Throughout, protect auditor independence, no gifts, no job offers, no social entanglements. Can your company keep operating? You must answer that under the going concern standard, evaluating the 12 months after the financial statement issuance date, not the period end. Step 1 asks whether conditions raise substantial doubt about meeting obligations as they come due, things like recurring losses, negative cash flow, or debt that cannot be refinanced. If no, document the rationale and stop. If yes, Step 2 asks what management's plans are to mitigate, such as raising equity, refinancing, or cutting costs. If those plans alleviate the doubt, you disclose the conditions and the plans. If they do not, you disclose that substantial doubt exists. Because the test runs to issuance, a condition arising after period end still gets disclosed. Why is December harder than every other month? Because the year-end close adds procedures on top of the normal monthly routine. You run a full physical inventory count with auditor observation and a fixed asset verification to find ghost and unregistered assets. You perform the annual goodwill impairment test for each reporting unit and test indefinite-lived intangibles. You send a year-end letter to outside counsel for the legal contingency note, and you review subsequent events through the issuance date. You prepare the full income tax provision, updating deferred taxes and the valuation allowance. And for public companies, management assesses internal control as of year-end, disclosing any material weakness publicly. Only when all of this is done is the period permanently locked. Let us bring it together. Management reporting turns your closed books into decisions through three-way variance analysis, bridges, the dashboard, and a chief financial officer commentary that must stay consistent with external disclosure. External reporting follows fixed securities and exchange commission deadlines that depend on your filer category, with each form carrying defined contents and XBRL tagging. The external audit succeeds when you manage the provided by client list and protect independence. The going concern test runs all the way to the issuance date, and the year-end close layers on inventory counts, impairment tests, the tax provision, and the management report on control. Thank you for completing this section on management reporting, SEC filing, and the year-end close.